Hello, hello. Welcome to tonight's session. Our monthly chartathon, July 1st, 2024. My name is Hamilton. I appreciate the opportunity to be able to yap at you for about 65 to 75 minutes, depending on how fast I yap. We have a lot of ground to cover, 119 slides. It's going to be good stuff. If this is your first time inside of one of these strategy sessions, hello. I hope you gain a bunch of value out of what we're about to go through. Essentially, the way we like to structure these charting sessions, everything is going to be viewed either on a weekly or a monthly time frame, generally speaking. We're really looking to focus on the broader picture. All right. We want to start with market trend. What's going on with different sectors, industry groups, etc. Then we move into some sentiment work where we look at how do the players in the market actually feel about it. We look at market positioning, particularly the biggest players in the market. How are they positioning themselves within the market? And then we move on to some charting work. Most of this presentation is going to be charting work. We're going to be reviewing positions that we're currently in inside of TTI. We're going to be reviewing new trade ideas that you're going to be able to take if you like them through the summer. And we're also going to be reviewing some of the charts that you guys had an opportunity to send in. I added as many as I could, but the slides were already at 119 slides. And if I were to have added every single slide that came in, this presentation would be 2 or 3 hours. I love the enthusiasm, but for your own guys' sake, I'm sure you want to hear me yap, but probably not for very much longer than about 70 minutes, all right? So we're going to go ahead and start here in about 30 seconds. If you have any questions in the meantime, feel free to post them. If not, let's grab some water. At the end of this, if you're not currently a member of TTI, I'm going to talk through 2 of the ways that we offer help. If you'd like to leverage our expertise, I'll talk through that at the end. So if you're new and you're interested by the end of this, feel free to stick around and I'll go over both options. Without further ado, let's go ahead and start though. Welcome to tonight's monthly chartathon, July 1st, 2024. We're going to talk through our summer roadmap here. So disclaimer, first things first, please don't be stupid, guys. Don't risk more than you can lose. And please don't misconstrue anything we say today as buy or sell recommendations. We're just looking at charts, guys. That's it. Not telling you to buy or sell anything. That's completely up to you. You can do whatever you want. You guys are adults. For those of you that are newer to TTI, I'm going to talk through really quick the tenets of why we do and how we do what we do. Because for some of you, this might be the very first time that you're experiencing something like this. First things, we only focus on price. News is noise, and everyone else lies. That's basically the way we think about it. Your opinion, my opinion, the opinion of your grandmother's plumber's uncle does not matter. The only thing that matters is what is price telling us. As technical traders, price is our greatest edge. Secondly, absolute and relative strength. Own the strongest stocks. That is arguably 1B. If price is 1A, strong stocks are 1B. We want to focus on owning the strongest stocks as often as we can. It's not always perfect, but we tend to put ourselves in a pretty good opportunity, a chance to own that stuff through scanning, etc., which you're going to see in a little bit. And lastly, momentum. We don't want to be buying stocks that aren't doing anything if we can find a way to focus on the charts that are doing something, right? We all know what opportunity cost is. Essentially, when we're looking at charts and trades, maybe they're lower ADR, they don't have a lot of volatility going through them. We don't necessarily want to spend a whole lot of time on those particular trades, and so we look for momentum. Also, when we're already in a trade, momentum allows us to understand whether or not we should be getting out of that trade, right? Makes sense? Hopefully it does. So let's go ahead and start. Here's the 30-year history of the SPX. I love starting with this specific chart because it allows us to put the market environment into perspective. Secular bear market, secular bull market, etc. Where are we right now? We are in a secular bull market starting in 2013. The COVID crash is down here. The bear market crashes down here. Everybody freaks out always when anything happens in the market. If you're a swing trader, you are, by definition, holding stocks more than one day, right? Market closes, market opens back up, and therefore it's working. If you're focused on the intraday moves as a swing trader, a position trader, a long-term investor, you're going to be doing yourself a disservice. The market goes up more often than not. This idea of secular bull and secular bear can give us a great framework on how the market's moving over the grand scheme, right? Secular bulls generally tend to last 15 to 20 years. Secular bears tend to last 10 to 15 years. We're currently on year 11 of a secular bull, which historically speaking should last at least another 5 to 8 years, all right? So when things start to pull back, instead of running for the hills and worrying that the market's going to crash and it's never going to come back, just understand that generally speaking, going back over 100 years, these cycles tell us that these are generally pretty good times to buy the dip. Obviously within your time frame, you don't want to just incessantly buy the dip, but it pays to not be a doom lord, right? Not to think that the markets are going to zero and they're never going to recover. So hopefully everything that we talk through, you look at it through rose-tinted glasses, a little bit of optimism. Skepticism is totally okay, but understand that market cycles last, particularly those seculars, decades, and we are currently in the middle of a very bullish one of those, all right? So year-to-date, U.S. sector performance, tech and communications leading here. Tech, for the most part, has been led by semiconductors, which we're going to see in a second, but there is some sector rotation going on under the surface, which we're going to see in the next slide. That is still helping tech outperform, right? There hasn't been a whole lot of opportunity outside of tech so far this year, at least in terms of holding trades for the long term, because semiconductors have really outperformed everything. But communications has recently started to pick up with Meta and Google breaking out into all-time highs, Netflix about to break out into all-time highs, etc. The rest of the sectors underneath on the year have just blatantly underperformed. If you're not outperforming the benchmark, you really have to ask yourself how much of your portfolio do you want inside of those sectors? For example, is it worth going out and buying a bunch of real estate? Well, year to date, no, it's down 3.98%. Are there going to be individual stocks within the real estate sector that work? Absolutely, but from a sector standpoint, it is probably not the best decision to pump a bunch of cash into the real estate sector, right? So we're going through here. It says YouTube screen is frozen. Let's go ahead and look at this. Can't see the screen. Oh my gosh, why can't you see this? Can you see the screen now? Let's go ahead and wait and see. If so, we'll just go ahead and start over. So it's only about 2 minutes in, and we'll just do it from the browser. Can you guys see it now? All right, so we're going to go ahead and not maximize it. That's totally okay. Let's go ahead and start really quick. Just so you can see the slides, I don't have to say it again. You heard me. Here's that brief history of the 30-year SPX. We're currently year 11 in the secular bull market. If you're inside of TTI, we talk through this all the time. This is something that's super important because it allows us to build that framework on these market cycles, right? When the market crashes, it always feels like the end of the world. Historically speaking, it's not, okay? We have another 5 to 8 years of this secular bull market, historically speaking. Let's make the most out of it. Like I tell my guys all the time, dance until the music's over. Make as much money as you can. Let's go ahead and keep going over there. This is the next slide I was just talking about. Tech leading, right? Tech outperforming, communication starting to outperform. There's real estate at the bottom. These year-to-date trends can typically tell us where a majority of our cash should have been placed and give us clues into the future of where can we properly allocate our cash in our portfolio. As of right now, is it worth buying some of the laggers? For example, materials coming down, real estate not really performing, right? It can help you move away from some of the stocks that historically are, at least this year, not working well from a sector standpoint, entire group. And what we like to do here is anchor back to the bottom of the previous pullback, which in this case is April 19th, right? So we had that weakness from about end of March through the middle of April. And we like to anchor our sector and industry trends from that date because it allows us to show which parts of the market have started to rally since the market pulled back, right? That sector rotation that we were just talking about, which we're currently in right now as well. Tech outperforming, we know that. Semiconductors have really outperformed. Then you have the S&P 500 up 10.19%. and then everything else underneath it. Now, it's hard to tell from this particular chart. We're going to look through the individual charts in a second, but there are certain areas of the market that are now starting to outperform, right? Particularly over the last week, 2 weeks, and therefore it's going to give us an opportunity to roll cash into other areas of the market instead of just tech. But look at the laggers of the group, particularly those that are starting to curve to the downside from April 19th. The market's up since April 19th, and we have sectors that are now starting to curl over into the negatives. Is it worth our time, our opportunity to buy those types of the market? Probably not, right? So we're going to focus on where the strength is. Year to date, semiconductors. If you haven't been long semiconductors this year, what are you doing, right? I understand everyone's afraid of a bubble. I get it. But historically speaking, bubbles are a great time to make money as long as you're not the last guy holding the bag, right? George Soros talks about it all the time. We talk about this inside of TTI, this general idea of reflexivity, this concept of George Soros always talks about if you see a bubble, why would you run away from it? Run towards it. Add to the bubble. Just don't be the last guy holding the bag. Bubbles tend to bubble a lot longer than most people expect. NVIDIA, which we'll see in a second, probably going to continue to go up a lot more than most people expect. Semiconductors up on the year right now, 48.17%, excuse me. You have a small fraction of the energy industry, AMLP, currently up 17%. You have the benchmark SPY up 15.2%, and then everything else. Once again, people have talked about narrow leadership, market breadth, which we're going to look at in a second. Market breadth has been terrible this year, and they're not necessarily wrong. But here's my counter argument. If market breadth is wrong and the leadership roles are narrowed, doesn't that make our job as stock pickers a lot easier? Just look for the few that are really carrying the market. Some people are going to run away from those. They're going to say, that scares me. Totally fine. You don't need to participate. But for those of us that follow price, we have to. And it makes it easier when there's less stocks available to own, right? So not necessarily saying, market breadth not being the best is great for a bull market, but it is from a stock picker standpoint more simple to find the stocks that are working. April 19th, Anchor Semiconductors, once again, outperforming. We're starting to see some rotation out of semis. We're going to go through that specific chart in a little bit. Not necessarily something to be worried about, but it does offer opportunities in other areas of the market. Once again, a little hard to see here because there's so many lines, but look at the blue line there. That's your software space after bottoming at the bottom of May, starting to hit higher highs. You have internet names, a part of the tech sector, bottoming out, starting to hit higher highs. You have regional banks bottoming out, starting to hit higher highs. You have biotech, which we're going to talk about in a second. So for you small cap guys, biotech starting to bottom out and hit some higher highs. Not everything is going to get crushed in this sector rotation. And that's where there's a lot of opportunity. Factor analysis, what we're looking at here is not only growth versus value, but also market caps. A big part of our process is understanding where the big boys in the market are positioning themselves in terms of market caps. Everybody wants to be a small cap trader because they're very volatile. They offer some huge returns. But if the market is not giving the types of setups for small caps as a group to run, it's going to be very, very hard for those breakouts to sustain themselves. As of right now, and I'm sure you're aware, this has not been the greatest year for small caps, right? Outside of GameStop and some of the meme stocks, those Russell 2K stocks have not performed well on average, and we can see that year to date. As a matter of fact, realistically, going back to the middle of May, the only area of the market that should have been bought was large cap growth. That's that IVW. Those are your Mag 7 type stocks. And we should know that. If you guys have been trading over the last 2 weeks, nearly every single Mag 7 stock is at an all-time high. Some guys are going to look at that and go, I don't want to own Mag 7. That means the market's about to roll over. Listen, guys, I don't know what to tell you because if the market doesn't roll over, you just blew some incredible opportunities and entries with arguably the strongest stocks and the biggest stocks in the world right now. IVW off of that April 19th anchor, that's where the strength has been. Everything else has underperformed the benchmark. Mag 7 stocks have been the place to go. Just so happens we own a majority of those. We're going to talk through each one in a little bit. What I'm looking for here is some sort of rounded bottom action going on here, particularly with IWO, which we might be starting to place a floor here. If there is, that does open the doors for some new opportunities in stocks, different areas of the market to own. As of right now, though, they're still bottoming out. And if you're trying to layer bets in as something is bottoming out, guys, there's lots of strikeouts. I'm not saying it's not profitable when you catch a couple, but you have to be willing to swing the bat during these bottoming out processes and strike out. It's like a Babe Ruth style. You're going to strike out 5 times, but you're going to hit 5 home runs down the road as well. So if you want to start buying these as they're broadening out, feel free. I'm not necessarily that type of trader, but I'm very aware that this process could be happening right now, and I'm not mad about it. Obviously, we own Mag 7 stocks, but if these things start to round out and show some relative strength for the first time in a while, I'm going to be a buyer, and we're going to talk through a bunch of those charts in particular in a second. M2 money supply, I just want to show you guys there's a lot of garbage going around on the internet that, quantitative tightening is killing the market, blah, blah. Money supply is going up. Does it have to be any harder that when money supply is going up, generally speaking, market liquidity is going to be going up? And it is. That's all this chart's showing you. Don't be afraid to buy stuff right now. Doomsday preppers are telling you that the economy is about to crash. Generally speaking, in this type of environment, the economy is not about to crash. There's always that black swan, but listen, guys, we can't prep for a black swan, so why even stress about it? The S&P 500 on the weekly, we are very close to our first profit target there. When we went back, for those of you in TTI, if you listen to those December strategy calls that we had, and we were going, listen, when we break out into all-time highs, let's just throw some fibs across the top and target something out there. We were looking at these targets to get hit. 550-ish in the S&P 500 through SPY. Did we expect it to happen by July? Absolutely not. I'll be the first to tell you. We're very bullish all year long. We've been long all year long. We've only taken like a handful of shorts, and half of them didn't even work because we're in a primary uptrend in a bull market. But here we are, almost hitting our first profit target only 6 or 7 months in. Pretty wild to me that we're in this type of environment right now. Once again, I have to tell you, and we talked about this a lot just a few months ago, this was the 6th or 7th best start in the last 70 years for the market. Say that again. This was the 6th or 7th best start in 70 years for the market. For those of you that are sitting on the sidelines or afraid or praying for the downfall, you've missed out on an incredible opportunity. The good news is, generally speaking, when the first 6 months are incredibly bullish, the last 6 months aren't that bad either, meaning there is a bullish bias there. So if you're still sitting on the sidelines, wondering if you should be throwing capital into the market, stats show probably not a bad idea, right? The Qs here also up near our first profit target at $500-ish, currently trading $479. Once again, just like the S&P 500, very bullish all year. But did we expect this to happen as fast as it did? Absolutely not. I'm not mad about it though, right? Small caps. There's a lot of questions about small caps. I'm not going to talk about what I personally think is going to require small caps to get moving, because once again, my opinion should not matter to you. All that should matter is what the charts are really saying, what price is really saying. From a TA standpoint, I will point out that this is, in my mind, a consolidation fractal up on top of a previous cycle high, right? So this is a stage 1 accumulation. Here's your potential stage 2 breakout. We're building a consolidation base. I'm not bearish small caps, but I'm not overly bullish small caps. I think we got a clear 210, and we're going to start seeing small caps pop up on our scans because biotech is starting to break out. For those of you, once again, that are loving those small caps, biotech is a great kind of proxy into that risk on type of behavior, particularly with small caps, right? So biotech starting to break out potentially into new 2-year highs, guys. And so small caps, remember, I will tell you this without trying to push my opinion on what I think small caps are going to do based off of policy. I will say that typically the market front runs policy, right? The smartest guys, the biggest guys in the world have ins. They have access to better information than the rest of market participants. If they catch wind that interest rates are going to get cut sooner than the rest of us, I would assume that you're immediately going to see that in some sort of move within the most interest rate sensitive groups in the market. Small caps tend to be one of those groups. So small caps above 210, I'm a buyer. They're not necessarily there yet, but I'm no way in hell am I shorting this. So hopefully that helps. Here's your mid caps, MDY, a lot like small caps. We're going to see this frequently over the next 60 minutes. Consolidation fractal up and over previous cycle high. Not bearish, guys. Not overly bullish, but not bearish. Generally speaking, primary trends up. We're holding previous cycle highs. To me, this looks like a consolidation fractal, and good old classic TA tells us that typically consolidation fractals resolve in the direction of the underlying trend, and the underlying trend is up off of those late 2022 lows. So I do expect mid caps to continue to break out. We've made a bunch of money in some great trades in mid caps this year, following Q4 of last year where we broke out into all-time highs. I continue to think this is a great area of the market, but we need to see it, right? We need to see mid caps from a total market cap group continue to break out probably above the 450, 550, 560, area. And that's when we're really going to start laying our bets back into mid caps. As of right now, we have some sporadic positioning, but nothing totally focused on that. Once again, a consolidation fractal. As long as we're holding that 36,300 in the Dow, is it really worth stressing about? I don't think so. I think the Dow moved incredibly quick for what the Dow is, and now the market is taking profit over the last few weeks or months, and the next leg up is probably going to be, or the next leg, is probably going to be up. These trends tend to resume over time, right? There's two different ways markets correct, through price and time, and the Dow has not corrected through price. We've hung out above previous cycle highs. It has corrected for the best part of the last 2 to 3 months, though, so I would assume that this eventually catches a bid, but we are going to need to see market breadth probably improve a little bit for Dow Jones to start really get going. Obviously, there's some huge stocks, only huge stocks in the Dow, but there's an eclectic group of huge stocks. It's not just tech. It's not just consumer discretionary. It's a true representation of the broader market, and as of right now, the broader market is not participating as much as tech and communications in this sense, right? So transportation, the Dow, old school Dow theory telling us that really the market is not moving efficiently until you got the industrials and the transportations moving in the same direction. I'll tell you now, the transportations are not the same as they were when Charles Dow invented this index 100 plus years ago. We got airlines now, we got railroads, we got everything else. As of right now, we've been in this long-term holding pattern, right? This is a horizontal consolidation fractal. That's all it is. It's just taken place over the last 3 years. So I would assume, because we're in a bull market, the Dow's starting to potentially pop back up. The Dow Jones Transportation is also going to pop back up. Are we looking to buy components of the transportation? Maybe, but I don't think we're really looking right now. I think we want to get this up and over the 16,800 area. What I will say, though, is if the Dow Jones Transportation and the Dow Jones Industrial move in the same direction, the market should be firing on all signals. So we will look at this. It's not necessarily something we're trading off of, but it's part of our analysis nearly every single week. Net highs versus net lows on the weekly. There are more net highs than lows, although it is very weak in the S&P 500. Generally speaking, market breadth is slowly improving right now, but it's not something that we're going to want to be screaming from the rooftop. It really is a stock picker's market, and the Qs as well. Once again, the Qs, NASDAQ 100 here, that there are more stocks starting to hit new highs than lows, but once again, it's not very strong. So this isn't the type of market where we're going to want to go out and like throw a dart at a dartboard and you're going to hit a bullseye every single time. You really have to be diligent about what you're owning in this type of market. And to be honest with you, it's been that way for the last few months. None of this has changed. So if you're seeing this for the first time and going, now I know why I'm hitting 25% of my trades, 75% aren't working, it's because you have to be a lot more focused on what's actually outperforming as opposed to things that are just breaking out on weak volume and then falling back into ranges. And trust me, we've traded those, but we've done a pretty good job focusing on just the strongest stocks, and market breadth is kind of confirming that that's what we need to continue to do. I love showing this chart here, particularly for guys that like trading VIX. Nothing wrong with you guys. I think you're fucking crazy, to be honest with you. But if you're trading volatility, I just want you to know that this area of volatility has been the norm for the last decade, right? The days of the VIX up at the 20, 30, 40 range and everyone's going crazy, just not normal. Not saying it can't come back eventually. Obviously, the VIX spikes, particularly when there's some huge pullbacks in the market. But where we're oscillating right now is the norm over the last 10 years. And by the way, this is a great environment right now to be buying options. You don't necessarily want to be a net buyer of options when the VIX is at 40, guys. You're going to be paying a bunch of money for a premium, and IV Crush is going to be everywhere. You're probably better off selling premium in that environment. So as of right now, VIX is down, back to the normal, and this is a great opportunity to be buying options again without having to worry about the market crushing you. Stocks above the 50 and the 200-day moving averages, you can see we're basing here. This isn't inherently bullish or bearish as of right now. I think this chart was taken 3 hours before market close, so I'm not entirely sure if we closed above or below the 50 area and the stock's above the 50-day moving average. But as of right now, this is neutral, right? For the guys in TTI, we looked at the weekly trend this morning. information telling us not necessarily the most bullish environment, not necessarily the most bearish environment. We have some cracks up at the short-term side. We're seeing that kind of in the moving averages as well. Once again, not something to necessarily sell all your stocks and run for the hills, but also not the type of market environment that we would have expected coming into July, given that this is kind of a Goldilocks zone. So it's just, once again, know what you own. Discretionary process. Don't buy everything. The put to call ratio telling us that there's really not a whole lot of people that are short. Tell you right now, you're going to see this in a second with the COT report. There's a lot of bearishness on Twitter, but there's not a lot of bearishness in positioning. There's just not. The put to call ratio is below 1. As a matter of fact, typically at these all-time high types of events, you would expect puts to really be cranked up because people are trying to time a top, and we're not seeing it. As a matter of fact, it's starting to look like there's a little bit of hangover going on with theirs. They're not willing to continue to go out there and buy puts and try to time the top. It just feels like, I don't want to say they're giving up, but it's not the same type of environment as it was just a few months ago where people were layering in puts for like quarters out. They're just not doing it anymore. High beta stocks, once again, like mid caps and those small caps, basing up here at previous cycle highs. Your high beta stocks are going to be your software stocks, your semiconductor stocks, your internet stocks, some of your oil, gas, and exploration stocks, etc. Things that move a lot more than the S&P 500 are basing up there at all-time highs, and we would expect that to resolve to the upside. We like trading high beta names. And here's that high beta versus low volatility. We're going to get into some market sentiment and some intermarket analysis here over the next few charts. We're looking at what does it make more sense to own right now. Higher beta stocks or lower volatility stocks. You can see right now that we're basing above previous cycle high. We're taking the high beta stocks, dividing them between the low volatility stocks. We're getting this beautiful ratio chart. There is no distinct advantage right now from group to group. You would expect in a bull market, things like high beta stocks would be flying, but they're not as an entire group. They're actually performing about the same as the lower volatility stocks, which goes to show you once again, you have to own the stuff that's working, not an environment to go out and just trade anything. One of the most fan favorites is your consumer discretionary versus consumer staples ratio chart. Think about it this way. When people have a bunch of money, where are you going to go and spend it? Right? You're going to go to Amazon, you're going to go to Tesla, you're buying the car, you're going on cruises. Those are your consumer discretionary names. When the market starts to get crunched up and people don't have a lot of money, where do you go and spend your money? Well, people are not probably going to go buy new cars. They're going to go and probably not even Amazon to a certain extent. They're going to go to Walmart. They're going to go to buy Coca-Cola. They're going to go to the grocery store, Kroger's and stuff like that. So if you think about consumer discretionary against consumer staples, in a bull market, you would expect consumer discretionary names to be outperforming and consumer staples to be underperforming. That's not to say consumer staples can't go up. They're just going to go up less than consumer discretionary. And in a bear market, we would expect consumer staples to outperform consumer discretionary. So you have these beautiful trends, right? That's all we're about. It's all technical traders do, is where is the trend? When we're dividing the absolute performance of the consumer discretionary space against the absolute performance of the consumer staple space, and we get a beautiful uptrend that typically tells us that we are, in fact, in a bull market, and it also tells us that we should probably be more long consumer discretionary stocks than consumer staple stocks. So it's nice to see this start to resolve. Consumer discretionary has really not been a great area of the market to own this year. As you can see, we've been in a relative downtrend this entire year, but hey, guess what? We have Amazon finally up at all-time highs. We have Tesla showing some signs of life, which we're going to go through in a little bit, and we're starting to turn the ratio back around. Is it time to start getting long consumer discretionary? Hint, yeah, I think it is, right? We already are starting to do that. We have a high-yield corporate debt versus treasuries. This is kind of giving us an idea of the health of the bond market. Bonds are starting to kind of falter here a little bit. We are still technically hitting a series of higher lows. We have a bond position on. We're not looking to buy the dip by any means. If it doesn't work, we're just going to take the loss. But as of right now, we are starting to see some little bit of weakening in the bond market. So something to point out here is that the bond market and the S&P 500 for the last 2 years have been very highly correlated. And so a ratio like this, generally, we would expect to be going up or sideways, not down. And as of right now, we might have caught a slight bid here, but we're starting to potentially roll over here. This is not necessarily cause for concern, sell everything and run for the hills, but it's something that we're looking at here because the bond market is the most liquid and sophisticated market in the world, and it typically front runs everything else. So if the bond market really starts to fall out, I'll be honest with you, I think the odds of an equity market falling out go up exponentially. As of right now, we're not there yet, but we're monitoring it, all right? The last one I want to look at here is just SPY versus gold. This is your classic stocks versus shiny rocks type of mentality. Is it better to own stocks or gold? Can you own them both? As of right now, the ratio is telling us that both of them on the S&P 500 and gold are about the same. There are some slight differences where stocks might be outperforming slightly right now, but over this year, they haven't been. As a matter of fact, gold has done very well this year. And if we actually look at these and compare them along with a correlation coefficient at the bottom here, closer to 1, closer the absolute performance is exactly the same, closer to -1, they're inversely correlated, right? That makes sense. Gold in the S&P 500 going back to the bottom of 2020, there's really not a whole lot of difference, and that might surprise some of you guys. Gold and the S&P 500 have not really been that different going back 4 years. Now, is that bullish or is that bearish? I don't know which one you want to put that, which bucket you want to put that into. We do have a gold position on the books. We're obviously very long in the market right now. We're going to talk through that at the end of this. But as of right now, the classic discussion, stocks or shiny rocks, it looks like you could have gone either. Really quick here, all world country. Right now, there is a significant amount of global breakouts. It's not just the United States. Lots of countries are breaking out. A lot of them are breaking out to all-time highs. The Eurozone in particular, lots of really good performance. There has been slight pullback, but ACWI confirming the bull market. And by the way, for those of you that are in TTI, if you think about the last charting session we had back in June, this was a consolidation fractal that we were expecting to resolve to the upside, and it does look like it is. So just like small caps, mid caps, high beta names, etc., this is the type of move we're expecting, a resolution to the upside. All world country is starting to confirm that, hey, you can actually go out and buy stocks outside of the United States unless they're China, right? So China here, KWEB, this is your Chinese Internet ETF. We love using this from an analysis standpoint. We don't want to own Chinese stocks with lots of size until we're above 33.5. And I'll be the first to tell you, we have done a very good job over the last 3 years of not owning this crap, and it has been crap. Guys, it's just from a sector standpoint, Chinese stocks have not worked well. But they did get us about 8 weeks ago. 8 weeks ago, we opened a position on JD, BILI, YMM, to a lesser extent BZ and PDD, and only JD worked for us, and JD gave us a free opportunity to hold it through January, but as of right now, JD is dead. So just continue to point out that everybody wants to talk about China is the space to own. China has all of these great macroeconomic, things going for it, monetary policies easing and blah, blah, blah. Listen, you can say that all you want, but until it translates into stock price appreciation on a quarter-over-quarter basis, this is going to continue to steal cash from everybody that tries to buy this crap. Guilty as charged. Still currently holding a couple of those Chinese positions, but don't feel great about them. As of right now, though, nearly every area of the market in emerging markets is doing something that's productive. Chinese stocks, not so much. So let's continue to focus from a TTI standpoint on emerging markets that are performing well. We're going to look at a bunch of those at the end of the session and kind of circumvent the annoying diatribe of you got to own Chinese stocks. You don't. You do not have to. Charlie Munger actually said before he passed away that BABA was one of his worst business mistakes of all time. And if Charlie Munger said that, it means something, right? So emerging markets, last charting session, we had asked, is this a consolidation fractal? Does it typically resolve up or down? As of right now, it does look like it's probably resolving to the upside. Equal weighted S&P 500, once again, know what you own. Consolidation fractal up over previous cycle highs. Not a market to own everything. You got to know what you own. And then QQEW, which is your equal weighted Qs. This is going to weight things like Apple the same as the very last component of the Qs. Once again, consolidating up at those previous cycle highs, expecting all of this to resolve to the upside. But last time I'm going to say it, know what you own. Don't go out and buy the obscure shit that you're expecting is going to outperform over the next 6 months. Just buy the stuff that's already working. That's what the market is telling you to do. Really quick, let's talk bonds. Bonds, we did open a position here. This is a potential bottoming out process, but this doesn't feel great over the last 2 days. On Thursday, we started to slightly pull back. On Friday, we had a huge pullback, and today we had a big gap down. For whatever reason, we're not trying to figure out why bonds aren't working. The only thing we're trying to do is profit off of their movement. And as of right now, the position we have on TLT is not working. We do not buy the dip in bonds when it doesn't work. We simply stop out when or if we need to. As of right now, bonds coming down and testing that ascending trend line. Like I said, if it does find support here, great. We're not going to add in here yet from a TTI standpoint. This is something that would be considered a higher low, constructive price action. But listen, guys, don't sink a huge amount of your capital into anything. Doesn't matter if it's bonds, stocks, a different asset class that is continuing to draw down. And TLT is continuing to draw down. So like I said about 5 minutes ago, if bonds really fall out, that is a yellow, potentially red flag for the equity market. Inside of TTI, we're going to be focused on TLT over the next week. CTAs, we're going to talk market positioning really quick. So CTAs are your professional money managers, and you can see here the rate of their positioning over the market. Now, this is a survey. This is what they say, not necessarily what they do, but it's typically pretty good. You can get a general idea of how money managers feel about the market. The S&P 500, the Qs are at all-time highs, right? CTAs are underpositioned. What does that typically mean? Well, when CTAs get over 100%, if you look at where they got over 100%, July, right before the August and September pullback, December, right before the January, February pullback, March, right before the April pullback. CTAs are notorious for chasing higher prices because they have to based off of their client needs, right? If a client comes out and goes, Apple's at all-time highs, why the hell are you sitting in cash? They're forced to go out and buy this stuff. So money managers are notorious for causing a lot of these short-term pullbacks because they squeeze to the upside, or they don't squeeze, they pile into the upside and then get squeezed when prices start to come down. So something that I've really noticed here is that each new high the market is given, less and less CTAs want to play ball. And I think that's going to come back and hurt them. I think it's great from a retail standpoint if we're positioned long in the market. If CTAs are notorious for really going out there and buying the worst times, we're nowhere near the worst times from a CTA standpoint. As a matter of fact, we're not even anywhere near where we were in March, and the indexes are up, 5-6% from March. So really a good positioning here from a retail standpoint, and CTAs are once again caught off guard. They're eventually going to have to rush out and buy everything because they have to, and when that does happen, that might be a yellow flag for us on whether or not we should be expecting some sort of pullback, but not yet. Smart money is net long. This is your COT report. We're just looking at the S&P 500 here. Commercial traders, which are the smart money. These are the guys that have more information, better programs, more cash. They are net long the market, where non-commercial traders, your more discretionary, leveraged type of traders, are net short. I don't know about you guys, but typically speaking, I would rather be on the side of the smart money. They move markets. Speculators do not move markets, right? Commercial money is long. Non-commercial money short. CTAs are underexposed. That's part of the reason why I don't think this market is anywhere near any sort of top. It does feel uncomfortable from time to time. I get it, particularly during rotations, but from a positioning standpoint, we don't see extremes yet. So therefore, I think the market's just going to continue to go up, even if it consolidates over the next few weeks, which is what this is kind of talking to us about. Fantastic illustration from the Stock Traders Almanac of 2024. I'm a huge fan. I buy it every single year. I encourage you guys to go out and buy it. I'm not endorsed or anything to tell you that, but Jeff does a great job at quantifying lots of really cool historical statistical information. And in this case, 1949 to 2022, your S&P 500 election year seasonal pattern. That green line, at least as of right now, we're not going to talk politics, shows you if the sitting president is running once again. And as of right now, July 2nd, it's July 1st for you guys, excuse me. July 2nd for me, I'm over in Portugal right now. Biden is still running, and therefore that yellow or that red arrow kind of pinpoints where we're at, right? We're in this kind of Goldilocks zone over the next 10 to 12 days where, generally speaking, stocks do really well and then we start to consolidate. So the August and September type of time frame is typically when we see some consolidation. Potentially the market pulls back before that really big Q4 ramp. That's what we saw last year. That's typically what happens again this year, and that's what we're prepping for within TTI. As of right now, though, July 1st, we have a clear runway for the next 2 to 3 weeks to grab some great positions and try to get out at 100% and hold those things through Q4. That's the whole goal, right? Really quick before we get into actual trade ideas, remember the June charting session, guys, when the May bullish engulfings are coming in and everyone is freaking out and everyone thought the world was going to end, and then June came through and gave us a 5% move. Just absolutely insane. That's all I got. Or it was May bullish engulfing. Yeah. And then we got a 5% continuation move in the indexes. So once again, it's if you're looking at this stuff from an intraday or even sometimes from a day-to-day perspective, and if you're on FinTwit or you're on YouTube, these types of services and people's commentary are all there to attract attention. And generally speaking, humans are wired to look out for fear more than anything else. And so it's easy to get dissuaded. But if you're a technical trader, this stuff, these types of candlesticks and things have statistics attached to them. Those bullish engulfings are typically pretty good. June stuck a 5.06% candle in their face. What do you expect is going to happen for July? We're probably going to hit that profit target at 550, if not even a little bit more. Definitely feels that way. All right. So that's where we're at right now. We're going to start going through some actual trade ideas. So we've set the stage. We're bullish, guys. We're bullish. We know which areas of the market we typically want to be long. We want to be long the text, the communications, anything that's moving up and to the right over the last few months since that April 19th. Financials are starting to kick up here. We have some exposure into some potential like crypto and stuff like that is not necessarily dying as much as people want to see. We're going to look at some charts there and kind of talk through them. But let's talk about new themes emerging first. First things first, software. So semiconductors, excuse me, semiconductors have been outperforming for the last, 18 months? It's not just this year. The best performing industry group last year were semiconductors, followed by home builders. This year, semiconductors by a very large margin, followed by AMLP, which is an oil industry. Typically, these things run for an extended period of time. And if any of you guys have your semiconductor SMH up, which you're going to see in a second here, this is the exact same pattern that SMH stuck before breaking out and running 50, 60, 70%. Now, I'm not saying software is going to run 50, 60, 70%, but I'm saying this is not a bearish setup, guys. Nice little cup and handle with a bull flag over to the right. We did take the liberty of front running some of this stuff, and we are expecting an all-time high breakout above 89 within a relatively short time frame. Not saying tomorrow, but probably within the next 1 to 2 weeks, we're probably going to see an all-time high stick in software. You got to ask yourself, what types of stocks do you want to own if software is breaking out to all-time highs? This has been an underperformer all year. Semiconductors are already up 40, 50%. Software is nowhere even close. Right? We're just starting to break out into all-time highs. Good thing Koyfin, also not sponsored, a program that we use every single day inside of TTI, gives you a general idea of stocks that are performing well within the software space. We're going to go through a bunch of them in a second. But you can see here, if you want to rewatch this video or pause it here, you can see the performance within IGV over the last year, right? Lots of huge winners this year. And we own a lot of them, and we're going to go through them. And now software is starting to break out into all-time highs. So let me ask you something. If there's some of these stocks are already up 100%, and software as an industry group is about to break out into all-time highs, do you think it's probably worth your attention to focus on those leaders? Yeah, I think it probably is. As a matter of fact, here's one of those names that we own and we've owned all year. App. This was one of the biggest trades we put on. This was 1,000% winner for probably half of our Discord group. A lot of these guys had their first 1,000% winners in App. We bought back here at the 45 breakout, currently trading 84. We have a current position on App. It's starting to break the descending trend line. Perfectly think there's a new entry here on App if you're not currently in it. This is a market leader in the software space. It's performed very well. If you go through your Koyfin, you'll see that it's one of the best performers on the year. This is something that we want to continue to potentially own, right? We own a position in here. We're not necessarily adding, but if you don't own it, why not, right? Above $85, target the $100 area, $15 move. Because there's been multiple weeks of consolidation, the options contracts have really come down in value. So it's up to you. If you like this type of setup and you want to run those 100 to 105 area price target, there is definitely a play there for you. Bullish momentum has been there since the middle of 2023. Fantastic opportunity to own a market leader in software. And then you can't talk software without Microsoft. Once again, we've owned this trade. This is our second time in the last 6 months. First opportunity was above the 350 all-time high breakout. Pretty simple, right? I think we actually opened it slightly. We front ran the all-time high. Really good opportunity for us back then in October/November. We opened it in November, at the very beginning of November, Microsoft. And here we are once again breaking out to all-time highs. We put a trade on this above the 434, 435 area. Currently trading 456. Not sure if there's an entry here if you're not already in it. We have some price targets up near $500. And beyond that. But really, these are your two big software stocks. This is one of, or at least one of the reasons, right? Microsoft being one of the bigger software, or the biggest software stock in the space, in the entire world. Of course, software is going to start outperforming when you have the giants like Microsoft, but it's not just Microsoft breaking out in all-time highs. There are components within software as well, right? So I encourage you to look through those. We're going to look through those in a second, at least some of them. Communications is the next new theme. I'm calling it right now. Communications probably going to break out into all-time highs. Now, comms have a varying amount of industries within them, right? It's not just like Meta and Google. Those are your two biggest. But you have social media names. You have telecommunication names. The best way that I could sum communication sector up is any business that has a reoccurring business model, pretty good, shot that it's in communications, right? And so communications here, just like software, the rest of the market's up at all-time highs. Communications nowhere close. I definitely think that comms breaking above 86 gives us an opportunity for this entire space to run. And there's a bunch of stocks that are outside of Google and Meta that are also setting up. We're going to look at a bunch of those. We'll start with Koyfin first, though. You can get a general idea. Not everything is working. So once again, understand what you own. Own the leaders: Netflix, Google, Meta, Fox A, T-Mobile. We'll go through a bunch of these in a second, but there's lots of different areas of communications that are starting to outperform in that sector from an entire sector standpoint, breaking out to all-time highs. So Meta here, we just put a trade on. We're down on it right now. We like it above 515 for the front run, and we're targeting 650, 700. We're going out there, guys. This is a Mag 7 stock. These stocks have been flying all year. This was the biggest individual win that we had outside of it was actually in our Discord group last year. We had a $150,000 win. Kudos to Dustin. If you're listening to this on the Meta trade, we've traded Meta essentially since the beginning of 2023. This is just one of those stocks that's worked very well for us. And we just entered a new position late last week. We're currently down on it. So if you like this setup, we're not even front running, you guys. We like it above 515. I'd probably wait until we're above 515 to own this and go out there with the strikes. If you're in TTI and you don't have this trade on, go look at the trade idea over on Circle. For those of you that aren't in TTI, I'm going to show you what that looks like at the end of this presentation. But we like Meta here. We also like Google, right? Another trade that we've put on recently, but we've also traded multiple times over the last 18 months. We like this above the 180 pivot. It's just really that simple. Buy it above 180. We have a price target of 200 and 225. Just that simple. Current trade's up slightly. Not a huge win for us yet. So if you like this, there's probably an opportunity. There might be a pullback on Google. But these Mag 7 stocks are the ones that are outperforming. Just own them at logical levels. Throw a stop underneath that would invalidate the idea and let these things go. I think the biggest issue most people have when they own this stuff is they're not willing to let this stuff go long enough. They want instant wins. And it's just not going to happen, particularly if you're a swing trader. Ironically, you will probably have bigger wins if you can keep your hand off the mouse and let these things move. Day traders, are obsessed with intraday moves. They feel like they have more control, but I'll be honest with you, having control is not necessarily the most profitable thing you could do because as humans, we tend to make some pretty bad decisions when our back is against the wall. So if you just buy this stuff with time and the expectation is set that it might take 3, 4, 5, 6 months, let this stuff play out. You're probably going to be very happy within that 4, 5, 6 months. As a matter of fact, look at Mag 7 on the weekly. All-time highs right now, right? So there's lots of areas of the market that suck. One area of the market that doesn't suck, owning pretty much any of the Mag 7. Even Tesla at this point is outperforming a lot of other areas of the market. Consumer discretionary is starting to pop up. We're going to look at that in a second. But Mag 7 stocks, pretty damn good. This has been a very good area of the market to own, and we own a majority of these. We're going to talk through all of them right now. All right, so let's look at tech in general. Everyone's worried about a semiconductor pullback. I'm going to give that speech in a second, but tech hitting that profit target up near 215. Is it a surprise that there's going to be some sort of respite? To me, absolutely not. I don't think so. I think that tech has led the market 2 years in a row now, and I think that tech is probably going to lead the market. I don't know if it's going to lead over the next 6 months or not, but it's not going to fall back into new bear market lows. I think that's absolutely ridiculous, but I also am not afraid to buy dips. We just want to buy dips at logical levels, so let's look at some of those. We're long Apple. For those of you that follow on any of the social media accounts or are inside TTI, I threw this kind of trade idea out there for everybody. We bought it at 197. I'm not going to tell you that we knew that Apple was going to break up 10% in like 2 or 3 sessions. I think that's complete horse shit. To be honest with you, luck has a lot to do with what we're doing in the market. We can't predict exactly how these things move, but we had an opportunity to own an all-time high in Mag 7 at 197. We did, and now we're in a massive, massive win. And the best part is we want to add into it. So the original entry we had down here in the Discord was near 164. We were able to grab that, leverage a lot of the profits into the 197 all-time high breakout. And now we have this massive position in Apple that we are holding October, Novembers, Decembers, and Januaries, and an opportunity to own more. So new trade idea on Apple's coming up above 21850. We talked about it today inside of the Discord. We want to own more Apple. We want to go out for that 250-ish for a price target, and we're probably going to want to go out to the Decembers or Januaries again. So I ask you very nicely, if you're already in an Apple position and you're in TTI and it's not free, first off, I don't know how you did that. But if it's not free, don't add into a trade that's not free yet, right? We don't want to add into a trade that still has risk because if it doesn't work, you're going to compound your loss. But if it's a free trade there, roll some of those profits into some longer dated Apple contracts and let's target that 250 area. We're not going to go into that night quietly. We're going to go out there and try to slam some home runs out there. Apple telling us the market wants this, right? It gave us a 10% move in 2 sessions. Those types of moves don't typically just stop. We had a year-long consolidation phase in the largest stock in the world at the time. Let's go and own more Apple above 218. CrowdStrike, another owner, or another stock that we've owned recently, but we've also owned it multiple times. For any of you guys that follow any of the content, we did a webinar on how we bought CrowdStrike back at 70 and then added in along the move to the upside here. We've been very hesitant about adding into CrowdStrike because at the beginning of the year there was some really nasty price action. It wasn't necessarily watch out, we're not going to own CrowdStrike. It's just watch out, we have to own CrowdStrike at the right time and because it wasn't easy. And so we are currently long CrowdStrike again. It's pressing up into all-time highs. There's not really a trade here, but for those of you that are in it inside of TTI, continue to hold that. Look for the $400 price target and then move stops up into a break-even state. Congratulations on hopefully a trade that we're going to be able to turn free relatively soon. Another trade right now that we aren't currently in that came up on a scan tonight, TTD, the trade desk. Here's your weekly going back to 2021. A little bit of a false breakout back in the end of 2021, but then we ushered in the bear market, right? So we're not going to look at that and go, there's probably a lot of overhead supply here. There's probably not. We look over at the VRVP. There wasn't a whole lot of buyers up there to begin with. The market very quickly beat this back down, and over the last 2 years has been consolidating sideways above 97.5. We like this up to 133.5. I mean, it's a pretty simple breakout. It's a 2 or 3 year consolidation phase. We're riding the 200-day moving average to the upside. There's bullish momentum within this name going back over a year. If you need a software stock, you're not afraid of owning a name that moves just a little bit slower. It's not going to be one of those high beta names that breaks out and runs 20%, probably. But this is a nice 2 or 3 year consolidation fractal breakout above 97.5, targeting 1335. Next one, Snowflake. This was given to us by somebody that's watching this, so thank you so much. We do not have an official trade on this, although a couple of guys inside of Discord do have this, so congratulations to the Discord guys and the guy that sent this over to me. To be quite honest with you, this is not normally something that I would be looking to buy. The RSI is below the 50, but kudos to you. Software stocks really started running. This bounced off of bottom support here, and at this point, I think the next logical level for a price target's got to be somewhere up near this high volume node, somewhere near this consolidation fractal where it spent 2 or 3 months there, and it looks to be about 160-ish, currently trading 142. So if you're in this, you have a hell of a head start. I'd be looking for that 162. For the rest of us that are looking at this, probably don't want to own Snowflake until we're above 197, getting out of this potential stage one. We did own Snowflake back here at the end of 2023, beginning of 2024, and it was an all right trade. We didn't make a bunch of money on it because it did get slapped after ER. But once again, if you're in it, congrats. If not, I'm going to hold off on it. Another software stock that we were trying to grab at 11. I don't believe anybody actually did, but I do think there's a new opportunity here above $18, targeting 22.20 and then $29, just running the Fibonacci extensions to the upside. I think this is a better shares trade than an options trade, to be honest with you. The ADR is pretty high, but I like the bullish momentum. I like the fact that we've been able to hold the big parabolic move off of the 11 area, which we were originally wanting to buy. And after a few weeks of consolidation, a resumption of the uptrend, that's exactly what we want to see, particularly off of high volume, which we saw last week. This is a buy right now above $18, targeting 22.20 and $29. Shares trade for the most part. If you can find something on the chain, guys, inside of TTI, feel free to throw that out there and we'll look at it tomorrow morning. But for right now, it looks like it's just going to be a shares trade. JMIA. I want to point out that we're not necessarily afraid to trade meme stocks, but we're not a part of the whole cult that goes out and just buys meme stocks. It's just not our style. Jumia, right, the Amazon of Africa that went, sky high back in 2021 is back on our radar. One thing I want to point out, I should have pointed this out at the beginning, about 99% of these charts are log charts for 2 reasons. One, because I'm on a laptop right now and it's easier for me to see all the price action. And 2, it's hard for me to be able to post these onside this Canva with a laptop because the way everything's formatted, I'm not going to be able to get the entire story. So if you're looking at this and going, that looks a lot different than my chart, it's a log chart. It just allows us to see all of the prevalent information and gives us, it just distorts, all the information is the same, but it distorts some of the distances, okay? So bear with me here. This is a rounded bottom with JMIA. I like it above 975 if we get up there. We're currently trading $7. I think the last time we were up here, we gave it the old college try. I think it burned a bunch of people. So the next time we're up there, they're not going to be as enthusiastic to own it. That's great for us. We want to own stuff that most people don't want to own until it's too late. So Jumia above 975, run the profit targets. $14.50 for the first profit target, $22 for the second profit target. This is one of those retail related names. We have a bullish momentum regime going on right now. Not a bad stock coming out of a potential stage 1 accumulation into a stage 2 breakout, but it's very, very important not to try to front run this stuff, right? front run this stuff with significant overhead supply, you could be holding this stuff indefinitely, and we don't want to be bag holders of a goddamn stock worth less than $10. Trust me, it's not fun, guys. So above 975, run the profit targets up there. VLTO, software stock that we've owned basically all year. We've added in twice, pulling back in towards that 94.5 add level. There's an opportunity to potentially add here if you didn't last time, but if you're in this and you added last time with shares, probably not a stock we're going to want to add into just in case it doesn't hold the 95 area. If you're looking for a mid-cap name, I believe it's still a mid-cap name, looking for a mid-cap software name, this thing is not the fastest mover in the world, but it's provided a pretty good uptrend for us. We first bought at 83.5. We took some profits on the way up and then re-added in at 94.5, excuse me, looking for a $100 to $112 move. Currently pulling back week over week. So once again, a very low risk entry here. If you want to try to grab the 94.5 area, throw a stop right underneath it. Profit targets up near that 100 to 112 area. If you don't want to, totally fine as well. But typically, you'll see that these previous price targets hold as support levels on pullbacks, particularly in areas of the market that are outperforming, and obviously software is right now. So VLTO, another area that you could potentially look at. Corning Incorporated, another chart that was submitted. Not something that I would ever really go out and buy with this type of price action. Typically speaking, inside of TTI, we always look at the left-hand side of the chart. And if there's a lot of price action, we typically avoid it. We don't want to own things that have higher odds of resistance. I mean, that's it. Previous buyers back here looking to sell at break even absolutely influences the momentum of trends and breakouts. And typically we don't like to own this type of stuff. Having said that, there is a horizontal level break around or above 37.5. You're north of the 200-day moving average. It's sloped up. You have a bullish momentum. I have no idea how long this is going to take to get moving because it's a slow moving name. This thing moves on average intra-week 4%, which is not very much at all. So if you're in this, I'm not entirely sure. I remember reading the comment that you're holding some options contracts. I have no expectation for how fast this thing is going to move. Just know that it's a pretty slow mover. You're over the 37.5 level. The target would be $45 if I were a buyer. Semiconductors. I think this is where most people are probably going to be focused on. What is going on with semiconductors? Like I said, it's the exact same setup as the software industry group. It's the same thing. It's a cup and handle, and the handle is being placed right underneath the previous all-time high, and look what happened with semis. Not saying it has to happen with software, but I like those odds, and that's why we're going along a bunch of semiconductor or software stocks right now. But semis, once again, price targets just getting hit and continuing to run. We haven't messed with this chart all year. Look at the fib levels, right? We've taken some profits, we've added in. We've taken profits, we've added in. Up at that 281 area, we were up there 2 weeks ago. Does it surprise the members of TTI that we have some sort of consolidation after a huge run-up? Probably not. Is this the top? Probably not, guys. I know that sucks to hear for a lot of people because they want to make $1 billion shorting NVIDIA and they want to have a movie made about them, but it just doesn't look like a top. There's no blown off the top on high volume. There's no capitulation move. There's still bullish momentum. Listen, guys, semiconductors have run 70% this year, I think. And over the last month or two, they're up 30%. Let this stuff breathe. The market is taking profits. They will probably continue to get bought. We're going to be very, very aware of buying the right side of the V. We don't want to just buy the dip because particularly if you're trading options, buying the dip can lead to catastrophic account blowups because if you don't pick the right expirations, right, everything goes to shit. So we don't want to just dollar cost average down. We want to buy the right side of the V. Think about NVIDIA here. Everyone's worried that NVIDIA is about to blow the market up. Once again, look at the volume on the 2 week ago, that type of inter-trend top. Does that really look like a top? Look at the volume. Come on. There's no capitulation there. There's no nasty move to the downside. There's nobody struggling to get out. It's uncomfortable if you bought up there. It's uncomfortable if you're holding recent semiconductor positions because there's so much correlation between NVIDIA and the rest of the semiconductor space. But does that really look like a capitulation candle? No, probably not. Not saying it can't continue to come down. Absolutely it could, but it's probably not the top. So we're going to be very patient when it comes to this stuff, and we're going to own it on the right side. And then for a little cheeky news clip there, everyone wants to say that NVIDIA is a fraud, a scam. Fuck them, guys. Just who cares, right? This article particular came out in September of 2023, but you can go back to the beginning of 2022 when people were saying Nvidia was a fraud. This thing's up from 47 bucks, split adjusted to 117. Screw everybody. You guys are technical traders. Own the bubble stocks. You make a lot of money on the way up. AMD, do we want to own it? Probably not. New positions. We already do own this. Reminds me of a lot of the other charts we've looked at, consolidating here up over a previous cycle high. Will there be an opportunity to own Nvidia again in the future? Probably. Do we want to add here? Probably not. If it doesn't resolve to the upside right away, it's going to suck to hold. So we're just going to put AMD on the back burner. If you're holding positions, feel free to not stop out unless we get stopped out on a technical basis, but we haven't yet. Probably not a name we want to add into. TSM, one of the bigger wins we're currently in right now. Just like Nvidia, 2 weeks ago, went up there, tapped that 185 price target. A lot of guys took some profit inside of TTI. Are we looking to add in here? Not yet. Eventually, yes, we're probably going to want to add in on strength, probably above the 185 area, target the next level up at 265, but we're going to just sit here and be patient. We're still holding TSM contracts. They're up multiple hundreds of percent. There's nothing to do here except wait for the consolidation and then eventually add into it above the next pivot, right? Micron, same idea. Earnings were apparently terrible. I don't care about earnings whatsoever, but apparently they were awful, and Micron is sticking a potential little reversal here today alone. We'll see if it continues to hold that 126 area. We do own Micron. These are up friggin' huge. Once again, do we want to add into Micron here? Probably not. We're going to wait, right? But everyone's worried about semiconductors dying. Does it look like they're dying? Probably not, guys. It just looks like some profit taking and some consolidation before the next leg up, at least as of right now. NXPI, we're looking to potentially add in here above 270, currently 265. Nice little consolidation fractal over the last few weeks. That descending trend line offers just a very easy risk on level. Own it above the descending trend line, somewhere around 270, and put a stop underneath the fractal here over the last few weeks. Looks like 265. And we're targeting 295 and potentially upwards of 350, right? So not a bad little semiconductor. Qualcomm, we have a position. Also, somebody asked for Qualcomm earlier today. We do have a position. You can see the entry that we originally grabbed. We took some profit on the way up. Once again, does it hold 193? All these semiconductors are showing more or less the same type of price action. They went up a lot, and now they're starting to pull back as people take profits. Is it the end of the world? Absolutely not. Will it open up new opportunities to own them? About 95%. Yes, I think they will. Is it time to just indiscriminately own them? Probably not. Let's own strength right now because who knows how long the sector rotation is going to last. ARM, I think it's one of the last ones we're going to look at here. Significant portion of my portfolio has been a huge winner for me since I originally bought it late October, early November. We're looking to add in here above 164. I already did, so I'm holding a new position here in ARM. I'm not looking to add in until that position turns free. As of right now, it's not. We're targeting 210 to 215 off of this ARM play. If you like semiconductors, this is not a bad setup. Right? You're getting some contracts for free. We're holding some October through January ARM contracts going out and over the 210 area. So if you like this setup in particular, own it above the 164 pivot, target 200 to 210, 210 to 215. Find the expiration that makes sense to you. Stop out if we close below the 147 level. The profit target and the stops are very easily identifiable given the fib extensions. UMC, nice little stage one accumulation. Stan Weinstein would have loved this, riding the 200-day moving average. Like this above $9. This is a mid-cap, I believe, semiconductor name. We don't already have exposure in this. Bullish momentum has been coming in all year, holding a nice little bullish momentum regime, riding the 200-day moving average, a little bit faster of a mover as opposed to some of the other mid-cap names that we've looked at in the past. We like this above $9 with profit target up near $11. Really simple here. Stop out somewhere sub 200-day moving average at around 850. Decent risk to reward, about 3-to-1 setup there on that UMC. Consumer discretionary, underperformed all year. And now it's starting to outperform. Look at that. Amazon's at all-time highs. Tesla's breaking out into yearly highs. This opens up a lot of opportunity for us guys, and we're starting to take advantage of it. I like consumer discretionary above 185 for a potential all-time high test at 220. Let's talk through some of these. Let's start with Tesla. We nailed the entry. First off, congratulations, we nailed the entry. Good job. Claps all around. Currently up and over the 200-day moving average on the daily. We have an opportunity to turn this thing free. We have lots of time left on these contracts. Having said that, we're going to want to add into Tesla. We're going to want to add into Tesla probably above the 215 area. And we're going out and we're targeting the grand slam. When Tesla starts to move, Tesla starts to move. Elon got paid. It doesn't have to be any harder than that. Bullish momentum is back in the name. We're hitting new yearly highs. Let's own more Tesla. As of right now, I don't have a new trade idea because we have one already on, but we're looking to add into Tesla as early as Friday or next Monday. So look to roll some of the profits that we have in Tesla right now into some longer dated positions. And let's continue to stay long this because it looks like we're just getting started. Amazon. Some of you guys already have a free position in this. Here we have the next big consumer discretionary name. This is breaking out into all-time highs. Why do you not like Amazon? I don't understand why people don't want to own this. Above 190, we have a price target of up near 250. It's very simple. This is a very long consolidation fractal. Buy the base. The bigger the base, the bigger the breakout. And this has been basing since the middle of 2020. I don't have any conceivable notion of why people don't want to own this. There's still time, by the way. Some people have it free already inside of TTI because they were able to buy a local bottom. I'm not currently in a free position yet. There's an opportunity to own this. If you're not afraid to own things going out to January of 2025, you have like 5-6 months to hold a Mag 7 stock that just based for 3 years, breaking out to all-time highs, 4 years, breaking out to all-time highs. Kind of a no-brainer. So above 190, we like this up to 250, potentially even further than that. Stop loss right now would be underneath the 190-ish area, given the fact that we've broken out and we're continuing second weekend, right? So pretty straightforward setup on Amazon, but I love it. Royal Caribbean, a slower mover that we've been in for quite a long time. Congratulations to those of you that have held on to it. It's now a free trade. Is this going to be a grand slam trade? Probably not. Is this going to throw millions of dollars into our portfolio? Probably not. But it's a nice win for us, right? From a shares perspective, this is up like 15-20%. And from an option standpoint, we have free trades. And depending on what you grabbed, you're currently up anywhere between 130 to 180%. So good job. We have plenty of time still left on RCL. There's nothing to do here. No ad, though, on RCL. Shark Ninja, a big win for us all year long. We've owned this setup. This is our IPO range breakout high setup that we love to run. This particular name IPO'd back in 2023. I had no idea what Shark Ninja was. I've been out of the country long enough to not know that they sold blenders. Totally fine. I think they sell vacuum cleaners and stuff too. We've added in at around the 66.5 level, and we're looking to add in once again above the 78.79 level. So we did add in actually at the 78.79 level. Currently still basing. There's an opportunity for you to own Shark Ninja above $78.79 with a price target at $100. It doesn't have to be any more simple than or complicated than that. It's a very simple trade. Own above 78 or 79. Put a stop right underneath that fractal low somewhere around 72 or 73 bucks with a $100 price target. That is a very high risk to reward setup. If it works out, you're going to get paid a lot of money for how much you're risking. If it doesn't work out, you're going to lose a small amount of money versus how much you could have won, right? So we like this. We've added in 2 times plus the original position. It's been a winner for us all year. Kava Group, another one of those IPO range breakout highs, but we did take the liberty of owning it early. Big upgrades right now coming in across the board. We've owned this thing multiple times this year. We've added in multiple times. We just added in 2 weeks ago as well, and we're pushing up into all-time highs. We like this stock above 94, 95 bucks, currently trading 95.70. We have a head start here. We've already started to open up the position, and we're going out towards the 115, 120 area. No reason to overcomplicate this. Buy above 95, 96, target the 115 area, expect some profit taking at 100, that nice big round number, and throw your stop underneath a previous swing low, probably somewhere around 91, 90 bucks. It doesn't have to be any harder. Another high R to R setup in a consumer discretionary name that continues to work for us all year. ONON, free trade for us, came up, tapped our price target. We took a little bit of profit. Some of you guys did. Is it worth a re-entry here at 36.5? I think that if your trade is free, there's absolutely an opportunity to potentially buy this pullback to 36.5 for the next run up to 44.50. Yes, if it's not free, absolutely do not add into this. ONON gave us a really quick and aggressive move. It's a nice little setup here, but do not add into losing positions. That's bad because if it doesn't hold 36.5, you're just compounding your loss. So we like this on a pullback to 36.5 with a profit target of once again 44.5 and then an ultimate profit target at all-time highs and upwards of 57.5. Dutch Bros, we have a position. This was also asked for. We love this position. It's just a very basic stage 1 accumulation into a stage 2 breakout. The old Stan Weinstein stage theory coming in here. We owned it above 39 bucks, currently trading 31.85. We have a profit target of 50 bucks. It's really that simple. I don't know if there's an ad here. I don't know if there's an entry here. If you already own it, I don't think it's a bad stock. Our stop loss right now should be somewhere where we entered it. It should be more or less a break-even trade on from a shares perspective. From an options perspective, I don't think it's free. I think it's up 70 or 80% right now, so we still have max risk, but we're targeting the 50 area, right? So above 39, we wanted to own it to 50, and it's currently working their way up there. Carvana, this was a requested chart. We do not own Carvana from From a community standpoint, this is the only chart I believe that I included that's not on logarithmic because I want you guys to see how absolutely ridiculous this chart is. Don't be afraid to own meme stocks. Carvana was one of those meme stocks for a long time. If the path is relatively clear, I will tell you though, for any stock that's as volatile as this, there's going to be pullbacks. Are you in the right type of emotional and mental space to be able to withstand pullbacks, or does your system allow you to time tops at a reasonably high rate? If you do, then please DM me afterwards because I would like to have that system. I have never been able to time absolute tops perfectly at a high enough win rate to be able to make as much money as I want. So I typically leave these positions on the books until trends are broken. Carvana, a nice uptrend going back to the middle of 2023. We've talked about owning this multiple times and we just haven't pulled the trigger. If you're already in this, I like it up to about 160 to 175. This previous area of consolidation going back to 2022. If you're not in this, there's a very interesting BRB setup, right? We had a high volume breakout last week. We're getting a pullback this week into a previous overhead supply zone. That's our bread and butter setup inside of TTI. So as long as you're owning this above the 120 level, targets somewhere near 160, 170, and your stop is probably going to be the low of last week, right? So decent R to R there. I think it's about a 3.5 to 1 risk to reward. There you go. For those of you that are in it, good job. Communications. We were just talking about all-time high breakout. Let's go through a couple of these. Netflix. We talked about Meta. We talked about Google. We have a current position in Netflix right now that we are anticipating the all-time high breakout. It's just as simple as that. Currently, the trade is around break even. It's not working as well as we had expected it to as Netflix consolidates here underneath the 700 area. But I think the worst thing we could do is not grab a position in Netflix and then watch this thing break out and we don't have a position. It's going to be incredibly challenging trying to grab a position in Netflix. If it's already up, it's an expensive trade to begin with. And if IV expands on top of that with any sort of breakout, we're going to be paying 50 to 100% more for the same trade idea we could be paying for right now. We like Netflix above $70 or $700. Call me crazy. We have an ultimate price target of $1,000. I think it's absolutely doable. It seems ridiculous, but so did Nvidia and so did Microsoft and so did Meta. You get what I'm saying here. Bull market, guys. Netflix, I think there's an opportunity to grab this up to $1,000. Having said that, if you're an options trader, you might want to grab some more reasonable strikes. If it does hit $1,000, you're deep in the money. Congratulations. But I think we're targeting like the 750 to 770 types of strikes here. We're looking for a move over $700. Let's meet in the middle. First profit target 750 to 800, and then from 800 to 900, and then from 900 to 1,000. Just step this up. We like Netflix. We have a position, and we think that if communications break out to all-time highs, Netflix is going to join right in. How about Reddit? IPO range breakout high. We have a position in Reddit. We've had two positions in Reddit, and we're looking to add in above $70, right? So there's that next profit target there on Reddit. We like above $70, $71. An opportunity for you guys to also join the trade if you want. It's just a very basic uptrend based off of previous IPO. $70 to $71 also is around that all-time high, right? So second day after Reddit IPO'd, we were up there. We cleared this overhead supply, which we do have some. Reddit's into big blue sky territory. That's what we're trying to position ourselves for. We already have a current position in Reddit, but if you don't, look to add in above $70, $71, previous all-time high pivot. You're in big blue sky territory. Hard to hate it there. Reddit, not a bad name to own. T-Mobile, you're talking about communications owns a bunch of different areas of the market. T-Mobile, telecom name. Nice little bull flag there on the parabolic move to the upside a few weeks ago. TA question for you guys. Where's the price target off of something like this? It's definitely not 186. Price target off of a parabolic move with a bull flag on top. You typically take the distance of the bull flag and the flagpole, add it to the top. I think it's like I don't remember exactly how many dollars this is, but we're going to say it's probably like a $16 move. The price target here is probably around $200 on T-Mobile. There's definitely an opportunity to own this from an option standpoint, but from a share standpoint, it's a relatively slow mover, so it might not be worth your time, but it's a telecom giant, and it's a part of the comm sector. So I felt like it's necessary to highlight T-Mobile breaking out in all-time highs, probably going to consolidate and resolve to the upside here very shortly. Verizon, the other telecom giant, everybody wants to own this over T-Mobile. I will never understand wanting to own names that are stuck underneath overhead supply, but above 42.5, there is an opportunity for a little stage one into a stage two breakout, targeting $50. That's also where volume starts to kick back in. So a nice little $7, $8 move here, 42.5 up to 50. Bullish momentum all year. Not a bad looking stock. Better options trade than a shares trade once again because it's a slower mover. All right. Financials. Nobody wants to buy financials right now. That's exactly why I'm going to probably buy more at some point this week. I already own financials. I've owned financials all year. I'm going to probably end up owning more financials because it's a hated area of the market, but it's consolidating well and the most important stocks are breaking out to all-time highs. This looks just like all the other charts where you're consolidating up and over previous cycle highs. I'm expecting a resolution to the upside. Most important stock in the financial sector, I'm starting to lose my voice, guys. I apologize, is JP Morgan, and JP Morgan went out at all-time highs today. So I've owned JP Morgan since the beginning of 2024. I'm unfortunately all out of my options plays. I only own shares at this point. This has been a very, very good trade for me personally. But for a lot of us inside of TTI, the options contracts were up 500-600%, and that's saying something considering JP Morgan is a slower mover, right? It's just one of those trades that when you put on, you're going to have to sit there and expect to wait a little bit to get paid, but it's been a pretty consistent winner all year. We're looking to add in to JP Morgan as early as tomorrow, depending on how the market opens up. We're going to look at some options plays here. I think the next level to the upside here is 230, 235. So JP Morgan, above where we're at right now, this 205 area, we're targeting 230, 235. We'll go out and find some options as early as tomorrow, as long as JP Morgan is holding there. Wells Fargo, we have a current position in plus an add. A lot of conversation last week on whether or not we should be looking to cut this. I'm glad nobody did. There's a new entry here on Wells Fargo above that 62 area, currently trading 60.59. So if you're okay with holding a slower moving financial stock, slower moving meaning go out there with expiration if you're an options trader, and if you're a shares trader, expect to own this for 5-6 months. Go out and own it. It's not going to kill you. It's probably not going to gap down 20% either. It's just going to be one of those nice, consistent winners over time, probably. But financials are breaking out. JP Morgan's breaking out. Wells Fargo's working for us. Good job to everybody that added. And we're looking to add in again above that 62 area. Citigroup, also kind of a slower mover, but tends to be working. We have two positions here. Second add is not working. So I need to point this out. Multiple months have gone by since Citigroup has resumed its uptrend. If you're holding a position back from April, and it's not free, don't add into the play. We don't add into plays unless we've de-risked the previous ad, right? So as of right now, the original entry on Citigroup, I believe most of us have probably already closed that. A bunch of us are holding that April ad. It's encouraging to see Citigroup poke its head up and start to look like it wants to break out again, but we don't want to add here unless we get that breakout, and then we can turn those free. So as of right now, this is a do nothing but sit. Goldman Sachs looking like it wants to continue to break out into all-time highs. This was something that went out in our free report that we put out in a newsletter. Really just a nice, consistent winner. Once again, we wanted to own it above 419, 420, currently trading at 463. There's also an opportunity to add here into all-time highs above 470. 470 targeting 515, 520, 525. Goldman Sachs is going to be an expensive trade, but there is liquidity on the chain to own it. This is a market-leading financial stock. Guys, Goldman Sachs at all-time highs. Do you really think the market's going to freaking fall apart? Probably not. American Express, another name that we've been able to own since the all-time high breakout. And then we added in a couple of weeks ago, a couple months ago. We don't want to add into AXP unless it's a free trade. And I don't think those contracts ever moved enough. From a shares perspective, though, should probably be a break-even trade with your stop at entry. And we probably should have got pretty close to getting stopped out. So not something we want to do here. Just sit and wait for AXP. This is my current biggest position on the books. And you talk about it all the time inside of our, paid community. I love this setup. I view this as a consolidation fractal up and over previous cycle highs. I've said that a million times. I still think it's true. We had an opportunity for Nubank to potentially break out into all-time highs off high volume last week, and then today happened, and we pulled back once again. I've layered out buys going out as far as October, November, December, and January. I mean, I'm deep. Nubank, I'm assuming that this is going to break out and go up towards that 16.5. But I'll tell you right now, I don't think this is worth a buy just in case this doesn't break out, just in case this continues to consolidate and or does not break out ever and actually breaks back down below. Probably not something we want to own. From an opportunity cost standpoint, we have owned these contracts for like months and they just haven't done a whole lot. So most of us are probably down on the play. Not something we want to do here, but still expecting a general resumption of the uptrend 16.5. And I do think if we get up here at this 16.5 area, there's an opportunity to add towards the 24.75. But as of right now, nothing to do here with Nubank except wait. If you're in shares, wait. If you're in contracts, there's nothing that's screaming we need to stop out yet, but it's definitely a do nothing as of right now. Bank of America pushing up into 52-week highs. We don't want to own more of it. Just something that's on the books. As of right now, I've owned Bank of America since that original entry back at the end of April, beginning of May, and this thing has just sat on my books slightly down the entire time, down like 15, 20%. I was up 10% today. I think the market closed and I'm down 10%. This is one of those stocks that is going to do what it wants to do. No reason to stop out, but not as strong as a JP Morgan, not as strong as a Goldman Sachs. Imagine that. You want to own names that are breaking out to all-time highs more than you want to own names that are breaking out of these big bases from the bottom. We're in year 2 of a bull market. Own the things that are breaking out to all-time highs. Bank of America, not a bad trade, but not something we're going to want to continue to add into, right? So good job. For those of you that own a grouping of major banks, a lot of them are working pretty well. Good job. We want to continue to own those, but we want to own those at logical levels and add in only if we've de-risked, right? So for those of us holding Bank of America, that's not us. NCR, Atleos, this is a name that a couple of us bought a couple of weeks ago. NATL, funny story. When we first looked up NATL, the sector in the industry told us that this was a biorobotics company. So we went out and bought it above 25.5. It's a very basic setup. And then I went through Koyfin later that night. Turns out that it's an ATM company. So I guess I own an ATM company, own a combination of shares and options contracts. It's a nice mover. I'm up 5.5% in the shares, and the options contracts are up like 25%. We're expecting a continuation of this uptrend with a profit. We had an original profit target up near 30. I think I'm holding 30 calls, so that'll be great. Above 30, though, we're targeting 37.5, and I do think there's an opportunity, particularly from a shares perspective, to own this stock above 29 bucks. We break this consolidation fractal. To me, this looks like a no-brainer. Own it for the bigger move. If you're not in a financial name, you want a little bit quicker of a name. Some of those major banks are going to take a long time to move, guys. This does not. This is a mid-cap recent IPO name. This thing is going to move quite quickly. So if you want to own a piece of the financial space, this is not a bad opportunity. Own it above 29 bucks for a profit target. I would be targeting up near that 37.5. Expect 30 bucks to have a little bit of resistance as people take profit. Corebridge, a name we've owned multiple times. Shout out Thomas. Thomas and I owned Corebridge for a majority of this year. It was a relatively large win, like 400 or 500% for us. We expected a bigger win, but it took its sweet time moving. Not mad I traded it. But mismanagement slightly. We added in just a couple of weeks ago. Now we're looking at potentially adding it again if it breaks the descending trend line, only if the trade is free once again. For most of us, the contracts are not free, but shares should be. So if you're in a shares trade, there's an opportunity to own more of this above 31 bucks. Profit target 37.5 once again. If we're in options contracts, don't add in until we can turn this free. But also, this is a mid-cap turned large cap financial space name, IPO range breakout high. You see the same setups that we're posting time and time again. That's on purpose. This stuff works, right? So Corebridge above the 31 pivot, targeting 37.5. Bread Financial. Here's a name coming out of a stage 1, right? So you have to pick. Do you want to own the all-time high winners that are continuing to win, or do you want to own the stage 1 accumulation bases into stage 2 breakouts? I'll tell you, there was a time when owning stage 2 breakouts was the best thing to do. I don't know if it still is, but this does at the very minimum give us a very easy risk on level. We want to own Bread Financial above 45.25 with price targets up at 59 to 60, and then a longer price target up near 81.25. Stop out underneath 40.50. This gives you a 3-to-1 setup from the get-go above 45.25 with a 59.60 price targets, about a 3-to-1. And then that 81.25 is going to be a monster winner if it does end up happening. And there is some light volume on the options chain. TTI, I will post the trade tomorrow. Bread Financial above 42.25, not a bad little opportunity. Once again, it's a little bit quicker of a moving financial name. Those big banks are going to take a while. This one is going to take less time, hopefully. Last financial name, Robinhood. We've added in 2 different times, plus the original entry. Are we adding into Robinhood here? I get asked every single week. No, we're not. At least I'm not, because the last ad we've had on Hood has just consolidated sideways. You see the last proprietary black circle? We don't want to add until that position goes free, and it's not free yet. As a matter of fact, it's around break even or up slightly, up 10-20%. We have some monster winners. This is up 500-600%. 200 to 300%, maybe even a little bit more, but the last ad is not worked yet because Hood has consolidated sideways. Fantastic name. I love it. Love the descending volume profile through the consolidation phase. Typically tells us that this is going to be a powerful breakout. Do we want to add into this right now? Probably not. We're going to want to sit here and wait for the profit target up near 30 bucks to get hit. For those of you that are not in it, not a bad opportunity for you to potentially grab this for a high R to R setup. Why is it high R to R? You own it right here with a price or a stop out right underneath this, the last few weeks low, which is very close Right now, currently trading 22.80, somewhere just north of 20.50 for a stop, and your price targets are minimum $30 as your first PT. So a high risk to reward setup for you. And by the way, like I said, I think we're up 10% or something in the last ad. So it's not even like we're front running the contracts. We've owned them for multiple weeks. There's an incredible amount of liquidity on Robinhood. So just go pick your poison out there and own the $30 area. I don't think it's an if, but a win. Robinhood looks very, very good here, and it's been a very, very big win for us. Energy, another area of the market I get asked about all the time. Not my favorite area right now, but there are two setups we're going to go through. I don't love energy from a sector standpoint until bare minimum above 94. I understand oil is breaking up, but energy stocks are lagging. Why that's happening, I couldn't tell you, but it does tell me that I don't necessarily want to own a lot of this stuff right now. There are two setups, though. Golar LNG, a natty gas name, above 31. This is just a nice 1 to 2 year consolidation range breakout with a target at 38. If you like energy stocks, here's one for you. Bullish momentum over the last few weeks, up into new fresh highs. Moves kind of quick for an energy stock. It's not my favorite trading vehicle, but if you want exposure into energy, potentially before energy breaks out, not saying it will, but it could, GLNG giving you big blue sky setup, 31, targeting 38. Next setup, here is a 10-year base. Talking about owning big base breakouts, this reminds me of UBS, the trade that we put on last year. UBS was like a 13-year base breakout, and we owned it and made like anywhere between 250 to 400%. Took a while, but it was a very, very good trade. We have Pilgrim's Pride Corporation, PPC, with a 10-year base above 38.5, targeting 53.50. I do want to point out this is a slower moving name, so if you buy this name, expectations should be set to own it for a while. And this is probably a better shares trade than an options trade because I didn't see a whole lot of liquidity. But that could change if this does break out into new highs over the last 10 years. I would expect some bigger names to come in the space and want to own it, particularly those that are underexposed to energy, right? Makes sense. Let's talk industrials really quick. This is not the industrial. This is the emerging market. I don't know why I did not add this, but industrials do not look fantastic. Is it underneath? No, I just straight up didn't add it. I apologize. Industrials don't look fantastic, but there are a couple of positions that we're in right now that we're going to go through. This was a position that was asked to be talked through, DoorDash, a position that we owned in November. This was a very big win for us from November through the beginning of 2024. We owned a combination of shares and contracts. We do not own it right now. I don't know if I'd want to own it. This looks like a potential topping pattern. I'm looking for some sort of support. I added the proprietary kind of black circle there for where I think there could be some potential support. I'm just looking at previous oscillation high over the breakout. Just be very aware that you're currently starting to break down below the 50 RSI. This looks like a pattern that might continue to break down more than not. Not a name inside of TTI that we're going to want to own. I'd be looking for some sort of base to be built and then buying the right side of the V. Hopefully that helps. Uber. We're along Uber, multiple positions in Uber going back a year. This has been a big win for us. We recently added it at 64, and we've been holding for a number of weeks. Just finally starting to get the push off 64 that we expected. It just took a lot longer to get moving than we had originally anticipated, but here we are, Uber, bouncing off 64. It's just a very basic all-time high pivot, right? We broke out. We added in at the breakout. We were able to turn these free and take a little bit of profit. Market decided to sell Uber back to 64. We took it as an opportunity to add back in. And here we have a pretty decent sized position in Uber off the 64 pivot. Probably not something we're going to want to add here, but our first profit target is somewhere up near all-time highs at around $78 to $80. And then the $95 is the first official profit target. If you're holding Uber, guys, try to turn that free as early as possible. I think my current position, the last tranche that I added is up 40%, 50%. So I'm looking at turn this free as soon as possible because this has been one of those trades that sat in our books for an extended period of time. And then obviously we're going to try to add in on the all-time high continuation, but it's still too early. BARK, this is a name that was also asked to be talked through. And at first glance, I really didn't like this setup. It's just not something that I would normally be looking to buy. But then kind of zoomed out, and this does look like a potential little stage 1 into a stage 2 breakout. I just think it's early. So if you're own Bark, I don't think it's the worst setup in the world. I think you're just early, which if it does work out, just means you're going to make more profit. I would be more interested in owning it above 215. I think that's a clearer level for risk on, risk off, and I'd be running the gambit for profit targets, $3, $4.50, etc. If you're already in it, it looks good. Personally, I would wait, but once again, if you're in it, I don't think it's necessarily the worst play. You're within a bullish momentum regime. This looks like it's based for the last 2 years. Not the worst setup. I'm actually kind of surprised. Like I said, when I first looked at it, didn't really like it, but then I started to consider it. I do like what I see. So shout out to whoever sent this in. I like this. I think this might be a setup from a shares standpoint that we would be able to look to grab inside of TTI above 215. And if it gets there, you deserve all the profit you got on the front run. Congratulations, amigo. Emerging markets, we've talked about this particular chart for a while now. We're holding consolidation above previous cycle highs. I think there's an opportunity to get long some emerging market names outside of China. So let's talk through some of them. We already have a position in SE, C Limited. We front ran this 2 or 3 weeks ago. We're currently slightly down on the play after being up on the play. We're looking for a front run above 88 bucks. Whether that happens or not, I have no idea. I thought the setup was pretty lucrative when we first entered it, but who knows? Given the fact that we gapped down this week and then got hit last week. Apparently there's some bad news going around on SE. I don't necessarily care, but we're currently in a position right here. We're not looking to add in until we get this current position free. As of right now, we're down on it, but we do love SE overall above 88 bucks for a profit target of 120. This is just a standard stage 1 accumulation into a potential stage 2. We just tried to get sneaky with it and front run the stage 2. We might get caught. I have no idea. Not looking to add here, but above 88, this should be on everybody's watch list. This is just a very basic horizontal level breakout into a new uptrend. So C above 88. Profit target 120.75. We're too early to enter a new position right now. Coupang, we also have a position in. Some of us actually added into this position, so it's just straight up down. But for those of us that were able to grab the original breakout, this should be a free trade. So I'm going to talk to you guys first. If this pulls back in towards that original $20 breakout, do we add in here? I think it offers a high risk to reward setup. If it bounces off 20, we just doubled the position with free money. If it doesn't, then we're able to just stop out right underneath for a relatively small loss, but overall should be a profitable trade on Coupang unless we let those contracts go to zero, which we very rarely do. For those of you that are in Coupang right now and it's not free, break below 20 and you're stopped out. We like Coupang here. I think this is just a simple BRB with a pullback towards previous overhead supply, but I could be wrong. So we don't want to add into a potential loser if it breaks below 20. As of right now, I still like Coupang above 20 bucks for a profit target of 25, 26 bucks, and then a longer term profit target of 35. Here's that IPO range breakout high. This one ended up building a range a few weeks after it already IPO'd though. This is a Uzbekistani fintech name, payment processor name. Pretty easy setup to identify though. We like it above 134. We're not there yet. That proprietary black circle kind of gives us an idea of where we're looking to buy. Running the gambit to the upside, 149.50 and then a 175 price target. Stop out underneath previous lows at 128.50 offers a 3-to-1 setup minimum and then a big win if we get up and over that 150 area. I really like this setup. I will be taking it above 134. I just don't know if it's going to be shares or contracts. I didn't have time to look at the options chain, but this is a setup that I've made incredible amount of money over the last 18 months on, and I'm going to continue to take these until they don't work anymore. So KSPI, a Uzbekistani payment processor, potentially breaking out into all-time highs. D-Market Electronic Services. This is a Turkish software name, HEPS. Massive stage 1 base going back to 2022. Doesn't have to be any harder than that. Look at all the accumulation. Massive accumulation base. Bullish momentum regime on the weekly. I like this thing above the 230, 240 area for price targets up near 320 and $5. I don't think it has to be any harder than that. Once again, pretty easy to understand. Not saying it's going to be an easy trade, but it's easy to understand where we're right and we're wrong. Once again, above like the 235, 240 area, targeting 325 and then $5 with a stop loss underneath last week's low would give us about a 3-to-1 setup off of the gate here, and then a potential big win if it breaks above that 327 and runs towards that $5 area. So once again, all of these are outside of the United States, right? So emerging markets are starting to move a little bit, starting to give us some opportunities to own this stuff with some size, and these are some positions that we really like from a TA standpoint. So if you like that type of stuff, feel free to enter a couple of them, and we'll see how it works. Let's transition in towards the last portion of the charting session here. We're going to talk through crypto and then gold, I think it is. So crypto, total crypto market cap. We're bullish crypto. I know it's probably, some of you guys are like, what the fuck? And some of you guys are like, hell yeah. We're not overly aligned with crypto. We don't think it's necessarily going to revolutionize the financial space. I'm looking at this strictly from a trading standpoint, from price standpoint. I'll tell you right now, it's very hard to see all-time highs within Bitcoin unless the crypto total market cap continues to break out as well. And it's really hasn't done anything since the beginning of the year. And ironically, Bitcoin hasn't either. That's not on accident. We do think that if the total crypto market cap breaks above 3 trillion, that's going to be a big blue sky type of territory for the crypto space in general. We think it will happen still, We are totally okay with that idea being invalidated. I'm going to show you where we originally entered Bitcoin and why we're able to kind of hold through some of the consolidation phase right now. But from a total crypto market cap above 3 trillion, we're targeting the 4.4 to 4.5 trillion. I think it's totally doable minimum, and that's going to cause crypto to break out. Until then, we're trapped underneath previous highs, and this is what we're going to look at here. Bitcoin trapped underneath this 65 to 70K range. There's no money flowing in the total crypto market cap. There's no money flowing in to Bitcoin in general. That's just how it is. We're in a holding pattern. This reminds me of the same consolidation fractal pattern as all of the other charts we've looked at. Generally, the primary trend resolves to the upside, so we are still bullish Bitcoin. Our first entry on BTC was around 28,000 back in October/November, so we have a huge head start here. In the entries, we've obviously added in slightly here, and everybody kind of has their own kind of thing with Bitcoin. It's not necessarily something we focus on a lot inside of TTI, but when there's clear breakouts, we're going to grab them. We want to own more above 70K. Line here in the sand, 65. I just want to see this thing start to base above 65. It's just not there yet. It's not necessarily time to close positions or anything, but we don't really want to be adding into this stuff from a trading vehicle standpoint until it responds well, and it hasn't been. It's just been doing a whole lot of nothing all year. As a matter of fact, a lot of the meme stocks, or meme coins, I should say, have really outperformed Bitcoin this year. So we're not bearish Bitcoin, but we are not necessarily full-on bullish Bitcoin yet. We have exposure, and we're not necessarily afraid to cut that if it doesn't work out. But it's kind of one of those stories. It's like let's wait for the move, right? Let's wait and see how this thing works out. Ethereum as well. Not really the greatest moves over the last few weeks. We're long Ethereum off of the original 2050 pivot back in October/November. You know, the ETF stuff's going around, everything else going around Ethereum. Is it worth really adding in here? For me, it's not. I'd rather add in above $4,000 for a potential all-time high breakout in Ethereum. Until right now, we're just in this sideways consolidation chop zone, and I don't want to throw money into something that's just going to chop around. Maybe it does eventually break out. Is it something that I want to own when it does? Absolutely. Is it something that I'm going to sit here and dollar cost average into? Absolutely not. There's an incredible amount of opportunities in the TradFi market right now that are actually moving. So Ethereum, when it moves, I'm going to be in it. I'm already in it. But as of right now, it's just a watch list candidate. Solana. I've owned Solana back since October/November. This was my first entry even before Bitcoin, I believe. And so I've added into Solana multiple times, and I actually got stopped out of Solana once as well with the big capitulation move back here. And as of right now, I'm just kind of tentatively waiting for Solana. I still hold a bag of it. I'm still up off of the original entry, but I definitely gave some profits back by waiting to get stopped out on the pullback. At this point, you know, I'm not looking to add into Solana until we're back up and over the 205, 210 area, and I do have a price target of 260 at all-time highs, and then the big price target of 400. Some of you guys are going to be like, what the hell? This is all just based off of TA. It has nothing to do with what I actually think about the coin whatsoever. I still have a bag of Solana. I just don't want to add in until we're above 206. I did add in back on a pullback to 170, and I got stopped out again. So I'm not willing to add any more capital to this name until we're clearly back up in an uptrend, even if that means not getting the absolute best entry, because I don't want to just continue to add capital and get chopped around. That feels dumb. Pepe against USD. I only add this as a joke because we do have guys inside of the Discord, and they're up a ridiculous amount, like thousands of percent from the original entry at Pepe. But the entry that we put out on social media back at the end of February, beginning of March, I just want to show you guys, for those of you that are not involved with crypto, the TradFi space has an incredible amount of opportunity, particularly if you're trading options. A lot of outlandish rewards there within that space, but the crypto market does as well. Crypto market, in this case, the Pepe move from end of February through the current date here has moved 650, 700%. You have a couple bucks and you're on a sector, or not a sector, you're on a broker that allows you to buy this type of stuff. Throw a couple bucks at this stuff. The TA generally works pretty good here. Buy the uptrends, buy the smiley faces, buy the base breakouts. We did. Just throwing it, these out here, that these aren't necessarily the worst things to own. Binance Coin, we want to own this above 670. We took a stab at this at 640. We got stopped out. That's all right. This is a massive holding pattern going back to 2021. We want to own this at all-time highs. If it's not at all-time highs, I'm not interested in owning it. Above 670, I want to own it up towards a potential $1,000 area. Last one here, I believe, ONDO. Another name that we originally opened up back underneath $1, currently trading $1.20. We're going to want to add into this near 137 to 140. We're going to talk about this on Friday, I believe, when Josh comes on. He's our crypto guy. We want to add into ONDOUSD. This does not look like a topping pattern. This looks like a continuation pattern. It's been a good trade so far. We're going to want to continue to own it. Coinbase, we have a current position in Coinbase right now. We're not looking to add into it because it's down. We've traded Coinbase multiple times over the last 18 months. It's a quick and aggressive mover, but because Bitcoin has been consolidating for the better part of this year, Coinbase has been consolidating for the better part of this year. Probably not something we're going to want to add into until Coinbase clears the previous fractal high back here near 270, 275. We have a current position on right now. It's down. We don't want to add into a losing position. Coinbase wouldn't count it out, but this is just chop here along with Bitcoin chopping around. I think this is the last Bitcoin name, CORZ. Here's a Bitcoin miner that we opened up above 425. This thing is up huge. Shares are up well over 100%. Options contracts are up anywhere between 400 and 500%. We have a new price target up at $15, $16. The current or the original price target was just 527, and we got there in about a week and a half. Very, very, very fast mover on cores. We're now holding January contracts that are up 500% for most of us. And it's free, and we've taken some profit. This particular name has supposedly pivoted away from crypto mining and in towards cloud storage with NVIDIA or some sort of semiconductor AI bubble spin. I don't really care what it does. All I know is I'm up huge on it, and there is an opportunity to add more above $10. So above $10 with a target of $16, your stop out's going to be somewhere below the descending trend line. Try to find a 3 or 4 or 5 to 1 setup. This is a very, very fast and aggressive mover, so don't be afraid at giving yourself a little bit of a wider stop, but obviously position size down slightly to give yourself some buffer if you do get stopped out. Love this name. I want to add in above $15. CleanSpark, this is the last name. This was requested by somebody that's watching this right now. I don't necessarily hate this, but it's not something inside of TTI that we would own. This is a very tight consolidation fractal. Reminds me of Coinbase and every other name that has a high correlation to Bitcoin. When Bitcoin gets moving, CleanSpark's going to move. I mean, that's it, right? There's a very high correlation. All of these things look relatively the same. This is not a bad setup whatsoever. There's a lack of white space inside of this consolidation fractal, meaning that the breakout's probably going to be pretty explosive. So if you own it, I would love, good job. If you don't own it, I think there's better names, but by no means am I advocating you should sell this. I think it's probably going to work well when Bitcoin does. Almost to the end here. Gold, we have 2 positions in gold. We bought the original breakout at 2050 using ticker GLD. We've added in during this consolidation phase. Remember the stocks versus rocks type of conversation? Which one's better to own? There hasn't really been a big clear winner since 2020. We own a position in gold. There's a lot of people saying that it's topped out. I don't think so. I think this is a consolidation fractal around a very logical place to take profit. That's it. The 2,400 area was kind of our first profit target. We tapped it. Took a little bit off of the position, and then we decided to add back in when it started to consolidate. So here we are. Gold looks good. There's nothing to worry about. We also have a gold miner position that is not working as well. The gold position is working a hell of a lot better than the gold miner, and I think that sums up gold miners. Gold miners are a very fickle group to trade. It's not an easy group to trade. And so here we have an EGO. We're not looking to add in here. If it starts to work for us and heads up towards that 19, we could potentially look to add in. But as of right now, this is just a hold on the books. And let's see if it works. Silver looks equally as good as gold. There's a lot of people saying that silver looks like shit. I don't see it. I see a breakout with a pullback into previous overhead supply. We're looking at ticker SLV here above 27. I like silver. Below 27, I don't want to own silver. We're currently trading 26.90. I have no position. We're going to move above 27. I don't see why you wouldn't want to own this up towards 33.5. Just a very basic 4-year range breakout high. It's just like every other name. Last stock here, the dollar. We've been range bound for the last year and a half, and it's allowed the market to catch its legs and break out into all-time highs. If the dollar breaks out into new 2-year highs, I think there's a problem with the market. As long as we're stuck in between this holding pattern, this consolidation fractal, the market has done very, very well. Now, the dollar is pressing up in towards the upper bounds of this consolidation fractal, so there is a yellow flag going off right now, but it's nowhere near breaking out yet. And so we'll see what happens over the next few weeks with the dollar. We know there's an inverse correlation right now with the dollar and the broader equity market. A rising dollar tends to hurt stocks, and a falling dollar or a dollar that's going sideways tends to do pretty good for stocks, right? So that's where we're at right now with the market, guys. There is so many trade ideas in there. I cannot believe it. The market looks fantastic. This is the most trade ideas that I've seen all year. And it's in a lot of areas of the market that most people are not buying yet. They're still looking at semiconductors. Not saying semiconductors are bad, but there's a lot of opportunity out there right now. And I think that if we're able to position ourselves ahead of everybody else, particularly in those names that are breaking out all-time highs, it makes our trade a lot easier. So let's go ahead and sum this up. What's the big theme here? Mag 7, retaking control. Did they ever really lose it? Right? 6 out of 7s are near, or 6 out of 7 are at all-time highs, are very near. Tesla's the one odd out, but it's new yearly highs. Mag 7 is where you need to have some position. Buy some of it. There's plenty of them that are breaking out right now that you can go ahead and afford. They're not too far gone. Amazon, for example, Meta, for example, etc. Do not close your early winners to chase new breakouts as long as you have enough time. If you're holding semiconductor plays, they're free. You have lots of expiration. I get it. It's sexy. Time the top. Make as much money as you can. The worst thing, though, is if you wake up on a random Tuesday and the semiconductor space gaps up 5% and you're playing catch up for the next 2 weeks and consistently getting chopped out. You guys are swing traders for the most part. Most of you guys are. We don't need to time the absolute top. We don't have to. We're looking to capture the 80% in between from top to bottom or bottom to top. Much needed break in semiconductors. Rotation's okay. How many trades did we just go through? And none of them were semiconductors. There's a lot of stuff out there right now. Weakness and chop after the middle of July through August is expected. So what we're looking to do right now is open up a bunch of positions, hopefully get the push over the next 10 to 15 days, turn a lot of those positions free, and then we're going to be able to ride through the waves of some chop, hopefully not getting stopped out. I use hopefully because, the only thing we can control is where we enter and where we stop out. We do not get to control what the market does. I think not enough people understand that. You don't get to control what the market does. We only get to control how we respond to it. If we have the general expectation that there's going to be some chop potentially post mid-July, it's going to make holding good stocks a lot easier, particularly if we've been able to turn those things free. So new areas to own that are on my radar that we are currently opening up right now in size. Communications and software. Meme stocks are a flavor, not a theme. Own them if they make sense. We did have a position in Chewy, not from a total community standpoint, but a couple guys put a position on prior to earnings. They caught the pop like late last week. Shout out to Dustin once again for a 2,000, 3,000% winner in Chewy. Good job. But remember, these are not moving as a cyclical group. It's not like, hey, meme stocks are running, go and own all of them. It's still a very pick the right stock as long as it's giving you a risk level, and then you can own it. And if you get the flow behind it, congratulations. They can really produce some outlandish returns, but they are very hit and miss. Right, so June through August, statistically great months to be long, particularly if you were long through June and the halfway through July. Remember, halfway through July starts to get a little bit weak. The fourth year of a presidential election cycle does kind of prop that up a little bit. You can interpret that how you want, whether or not we have an accommodative Fed through an election process. I'm not going to get into politics, but that is statistically proven that there is a little bit of some dovish flow coming in. But I would not expect the same types of crazy moves that we've seen through these summer months. Remember, Wall Street goes to sleep, man. They go on vacation. As a matter of fact, I wouldn't be surprised to see this week be low volume after Wednesday. So Wednesday has an early close, 1 p.m. Eastern Standard Time. Thursday, it's closed. Friday, we have unemployment numbers. But guys, do you really think Wall Street's going to leave early on a Wednesday and come back on a Friday when they have Thursday off? Probably not. So whether or not you want to be trading through the end of this week on Friday, obviously we'll be here and be looking to put positions on. I'd be looking for some weakness, to be honest, and buy some pullbacks, particularly for those of you, if you found some great trade ideas on these slides and you feel like you've missed them, I'd be looking to buy some pullbacks. I would not be afraid to own this stuff over the next few months as long as you got some great entries, right? So that's going to wrap up this portion of it. If you have any questions, feel free to reach out. Email me, hamiltondrips@thetradinginitiative.com. Twitter's probably easier because I'm on Twitter. At least it's on in the background all day. I check my email only twice per day. At How to Swing Trade, you can contact me there, DM me. If I don't respond to your DM, it's because you're behind the spam filter on Twitter. So feel free to comment on one of my posts and just be like, yo, man, I was a part of the monthly chart session and I'm trying to get a hold of you. At that point, I'll pull it up and we'll be able to have a conversation. That wraps up, the portion here. For those of you that are in TTI, I appreciate you. I'll see you in the morning. I'll have those trade ideas typed up for you. For those of you that are not inside of TTI, I'm going to give you a glimpse really quick at what it looks like on that market research side. Go over here. What we like to do is everything that we talk about on a consistent basis, we write up into these reports and we spit them out for you once or twice per day. These reports go out to your email, and if you want, they get sent out via our application as well on your cell phone. All of this stuff is designed to help people that don't have a lot of time to trade be able to read through these brief reports and get a general understanding of what we're talking about on the Discord side of things, right? I'll talk through Discord in a second. These reports come out 1 to 2 times per day. You can see they're very quick, brief little summaries of things that we talked about. They're jam-packed, filled with information, charts we're looking at, general ideas, why we are the way we are, bullish or bearish, etc. The goal is to cram as much information in as we can in as little amount of time so you can go on with your day. Secondly, we have these great trade write-ups, which I'm going to go ahead and show you really quick. Look at the Amazon one because I know a lot of people are looking to get long Amazon. These trade reports I type up. They take about 5 to 10 minutes to type up. They get shot out to you via email and cell phone as well. This is generally what the charts look like. I'm giving you the setup. I give you all the pertinent information, sector, industry group, market cap, the volatility, our entries, our stops, our take profits. If you're trading options, what the options plays are, if it's a shares trade, whether or not you should take shares. And then commentary. Why do we actually like the trade? And I think this is the most valuable part of everything that we do, is not only do you get to take the same trades that we take inside of the group itself, but you get to understand exactly why we're taking them so you can understand if it's good or right for you. And then also, obviously, you're going to learn a couple things. Why do we like Amazon up at all-time highs? Well, bullish momentum regimes, high risk to rewards, different types of things that we're looking at, etc. All this stuff is available to you on a daily basis, right? We have weekly webinars that come out. We have strategy sessions on Sundays that you're going to be a part of where we scan through all of the sessions. Everything is recorded and re-uploaded onto this platform. And once again, it's shot out to you via email and your cell phone if you have the application. I really love this platform. I put a lot of time into it. And once again, it's available to you if this is something you think you would like. If you don't have a lot of time and you want to leverage what we're doing, this is probably a really good place to look. We also offer a Discord, which I'm going to pull up really quick. Once again, if you're not interested in it, that's totally okay. But I'm going to pull it up right now so you can see what it looks like. So this is what the Discord looks like. We offer, on top of the market research portal, a trader development program. It's a year-long commitment, and you get to sit with me and the rest of the guys 5 days, 6 days a week, actually, for an entire year. You get to listen to me scream at you for an entire year. This is a fantastic opportunity for you to not only understand how we trade, but why we trade. And while you're trading, hopefully make a couple bucks. You can sit here and see some of the profits that we're able to make on a consistent basis. All of the trades that we've talked about today are going to be showing up in the positions list that we have. The benefit of joining the Discord, very obviously, and I'll be very blunt with you, is that if you're in here and you're getting yelled at on a consistent basis, constructively and within a professional manner, the odds of you succeeding over the long run are way higher. One of the number one question I get from people that are either paying me or not paying me is, are you still in this trade? And if you are, why? This is why people join the Discord. Every morning we trade live, every afternoon we trade live, and you understand the exact process of everything about what we're doing. Why are we holding this trade? Are we still holding this trade? Are we looking to close out, etc.? On top of that, we also go through trade reviews. I look through all of your recent trades over the last 20, 25 trades. We figure out what's going right, what's going wrong. We double down on what's right. We fix what's wrong on a variable by variable basis. And that allows us to be able to hopefully move your performance to the upside over time. That's why we ask for an entire year. I don't know about you guys, but you go to school for 4 years to learn how to use fucking Excel. It blows my mind that people think they can learn how to trade within a couple of weeks. It's probably why so many people blow accounts. That's why I ask you for a year. So it's completely up to you. If this interests you, there's going to be a link below. You can apply for the Discord if you want the full year. It's an application process. I read through, make sure that we're on the same page. We have a quick 30-minute conversation. You ask me questions, I ask you questions at the end. If it makes sense, extend the offer. And then once again, if you just want to leverage what we're doing inside of Discord, you don't have time to trade live, I encourage you to check out the market research site. It's on a quarterly basis, so you don't have to be locked up for an entire year, just a quarter. Guys, my name is Hamilton. I hope you guys found value in this. Take some of these trade ideas that we put out, put them on, see how they work. Let me know. Once again, reach out to me on Twitter. It's probably the easier way. Ask me questions there. I'll be happy to help. I enjoy our very long Monday night session. It's currently 1:36 a.m. in the morning. I'm in Porto, Portugal. I am going to go to sleep right now. I will catch you guys in the morning. Any questions regarding the video, please leave them below and I'll answer them when I can. Have a good night.